Thank you for that enthusiastic applause. That was wonderful. I really appreciate that. All right, well, I am very excited for this session. We were prepping for this, and the takeaway that I had was that if you have a bunch of lawyers trying to push forward innovation in a very frustrating regulatory environment for 4 years, you get really good, spicy takes and content. So very excited for this discussion. Before we get into the meat of it, I'd just like all the panelists to quickly elaborate on the introductions you just heard about their titles. Flavia, maybe you can go first.
Yeah, so great to be here. I'm Flavia Naves. I'm a commissioner with the Wyoming Stable Token Commission. We'll talk a little bit more about what that is during the panel. But I'm also off counsel at Hathaway & Coons, which is a law firm in Wyoming.
Awesome. Chris?
Chris Brummer. I'm a law professor over at Georgetown, where I teach securities and financial regulation, and I'm also the CEO of Blueprint, and we are a crypto disclosure company. We help to facilitate registration and disclosure requirements around the world.
Awesome.
And I'm Yelena McWilliams. For most part, I'm Chris's babysitter.
This is correct.
This is 100% correct. But I'm currently the head of the financial institutions group at a law firm, Cravath, Swaine & Moore. But before that, I was a FDIC chairman, a Fed lawyer, chief counsel in the Senate Banking Committee, and a GC at a large bank.
Awesome. And Mark?
Mark Weegen, partner with the law firm Dentons. As the intro said, spent some time at the CFTC last decade, and since then I've been involved in the crypto asset space at companies and now working as a lawyer advising folks mainly on regulatory issues.
Fantastic. All right, well, as you can see, we have the exact right group for this discussion. So before we get into some of the stuff that I know you're here for, like Genius Act, Stable Act, we'll get to that, I promise. But before we do, I want to level set a little bit, because I think one of the things that's most interesting to me about stablecoins is they are sort of a counter-cyclical success story, which you don't always see in the crypto space, right? A lot of times the success that we have or don't have is related to macro environment, regulation, and it just sort of goes up and down based on factors outside of our control. Stablecoins are, I think, in some ways the exception to that. And I would first like to just start by getting the panel's take on why that is, and why, even though the last 4 years I think have been very challenging from a regulatory perspective, we actually have seen a lot of growth and institutional kind of maturation of the stablecoin market. Why do we think that is? Maybe Mark, we can start with you and then work our way down.
Yeah, well, I think the first thing is that there's very clear utility, especially when you stay within the confines of the ecosystem. It's a terrific way to move assets around, to move value around. On the regulatory side, the thing I would add, and this is true in the United States because you obviously have wide use of them in the US as well. The legal and regulatory questions, I think, around stablecoins are a little less complicated than maybe some other types of assets, so I think that's been helpful too.
Yep.
There have been some folks in the official sector over the last number of years who have thought about whether or not a stablecoin might be something like a money market fund or something of that sort, but ultimately that was never concluded or decided. And so you compare that to some of the other crypto assets that are out there that have been issued, and a lot of those are not as clear cut. So I think those two things combined are probably the best explanation for it.
Yeah. Gillian?
And I'll add, stablecoin is stable. Like, let's not forget that the name is not just like out there for nothing, right?
Yeah.
There's something backing the stablecoin. And so I think from a regulatory perspective, certainly when I was at the FDIC, getting regulatory framework around stablecoin was the easiest thing to do in the digital asset space, right? Everything else is more complicated. So it's like, this is one thing that the regulators frankly could do, and I believe in many cases they could have done it under their generic authorities and didn't need additional regulation to allow banks to engage in this space, because the easiest scenario you could do is basically to say, stablecoin backed by 100% high quality liquid assets. We already have a definition for HQLA. The banks use it in other contexts. The regulation uses it in other contexts. Go.
Yep.
Actually, that would have been not that hard. And you know, there are some nuances. I'm oversimplifying. But the truth of the matter is, I think that, and without getting too political, I don't think that the prior administration had appetite to move in digital space at all. And so I think the stablecoin, even though it's the most simple, to your point, the most stable of all of the digital assets, didn't really, it was kind of a lodged in that grouping of things that couldn't move on the regulatory or political side.
Yeah, no, that makes sense. Go ahead. Yeah,
Well,
please.
one quick clarification. I think you and I are talking about the same thing. I'm thinking of stablecoins that aren't yield bearing, don't have some of those other complexities.
Right.
Just straight up one-to-one, 100% backed stable.
And I appreciate you making that point, because even now I think we're starting to see the term stablecoin being broadened quite a bit, and obviously we're going to get into the regulatory and legislative side of how we're defining different types of stablecoins. But yeah, as we talk about this, let's make sure to define what we're talking about, because I think
and
that's
if
a
I
great
can
point.
just add something, and you'll never get to speak after this. If I can just add something else, to your point, now that we're going to have an actual legislative and then a regulatory definition of what a stablecoin is, you're going to see a lot of things that are not like one-to-one, 100% back, trying to squeeze into that family of what's a stablecoin based on that regulation. So it's kind of interesting how, whereas the market drove the development of stablecoins up until now, the regulation will drive the kind of evolution from here on until we actually have more legislation and regulation for something above and beyond just a plain stablecoin.
Yeah, no, I totally agree. Chris, do you just want to like cancel out everything Elena just said, or?
I think they're all wrong. No, I think it's kind of interesting. I mean, when you think about the sort of history of stablecoins, I mean, certainly stablecoins came into the regulatory imagination, you know, with Libra, and they've evolved quite a bit since then. I think it's useful to sort of think of that as like the primal moment regulatorily where people understood.
God, I forgot about that. Honestly, it was so long ago now.
Wasn't it? I had to testify on that stuff, so I was trotted right into Congress for this stuff, so I remember it really well. Next to Gary Gensler of all people, you know, I think it's useful to understand sort of like that arc of the evolution of the product. There was always a good degree of sort of diversity in the product, right? You know, from algorithmic stablecoins. Right now, the emphasis regulatorily and conceptually is on whether or not you have like an interest-bearing stablecoin or not. But there's always been some question about whether or not it's a sole asset, whether or not you have multiple assets, whether or not you know, you should have some kind of stabilizing mechanism, and whether or not it should be permitted by Congress. But I think it is, and I think Yelena reluctantly makes a great point here, is that when you think about, you know, why these instruments are kind of popular, you know, because they are not necessarily, you know, they're not necessarily self-referential representations of value, you know, with some of the native crypto assets. So I think for many consumers and others, it's easier to understand what they are. But I think the other sort of driver was the fact that, as compared to the legacy payments and banking infrastructure, there are just like a lot of really neat advantages. I mean, you know, the 24/7 nature, you're not necessarily worried about the operating hours of the bank. You're not necessarily going to be as concerned about, you know, overdraft fees, you know, the cross-border applications, composability, the fact that you know, it enables new kinds of programming and integration into different financial services. I mean, that's the kind of stuff that, you know, tends to excite not just financial engineers, but just engineers. And if you can deliver new solutions for customers, whether or not institutional or retail, you know, that's going to create more interest.
Yeah, absolutely. Flavia, do you want to add
I
anything?
think if you've been in the payments industry for some time, you understand the pain points of what that is, how money moves today, how people make payments, how people get paid, right? How for me to get money to you, what's the dozens of people that are going to get involved in this for some reason.
Yeah.
So stablecoins deliver on a promise that the payments industry has been working on for decades and hasn't been able to solve. I myself, being a payments attorney by training, when I got into stablecoins, that's what drove me. I'm like, oh my God, we found the answer. Is this it? Is this the holy grail? I think the drive towards stablecoins is not only that, but also the trust in the reserves. I'm a strong believer that if you don't have a stable reserve, you don't have a stablecoin. That's it, right? If people don't trust that the reserve is stable, you do not have a stablecoin. And it can be fiat-backed, or it can be another token that is also called a stablecoin, but relies on another asset to peg to it. I do not call them stablecoins. I will call them tokens.
I'm sorry, you'd call them what?
I call them tokens.
Oh.
Just tokens. Commodity-backed tokens, or, you know, crypto-backed tokens, or algorithm-backed tokens. A stablecoin, which the Genius Act will help, to Yelena's point, draw that line that a fiat-backed stablecoin is a fiat-backed stablecoin, right? It's a stablecoin, that's what it is. But I think the promise and the trust in the reserves is critical.
Yeah.
So I think that's what has taken this during the last 4 years, even through the crypto winter. Why did stablecoins make through it, right? And everything that went through is because the reserves are there and people are trusting.
So let's flip it around now, because I think while we have seen a lot of success and growth in the space, I know from talking to the four of you in particular that there have also been a lot of challenges caused by the regulatory environment over the last 4 years. And I would like to get a little bit more of an on-the-ground understanding of how does that actually manifest when folks are trying to issue stable coins, build on top of stable coins. Can you sort of characterize the challenges of building in this regulatory environment that we're just coming out of? Flavia, I know you have probably a rant to uncork here, so we'll just let you cook.
Yeah, so because of the different regulatory approaches that exist today to this, it's not a lack of regulation, it's different approaches to regulation today, folks are uncertain about what to do. Unfortunately, stablecoin issuers do not have access to master accounts with the Federal Reserve Bank, which means that you need to rely on a banking partner to be able to run these transactions, right? Fiat to crypto exchange and those kind of things. And it's hard. You have to have the reserves placed somewhere that is safe, right, to be redeemed. So the lack of clarity on the regulatory approach is still a challenge for issuers as to how is it that they mint and redeem the token, as well as keep the reserves in place. The system, as we all know, has been a challenge for most fintechs, right? Not just stablecoin issuers. And with the recent rescission of certain guidance that was given by the Federal Reserve on crypto transactions by banks, we would hope that relationship would open up. But it remains a really big challenge for issuers to partner with different banks to be able to keep the reserves. So we will hope also with the Genius Act that it will provide additional clarity and potentially open doors for those kind of partnerships.
Yeah. Chris, you have anything you want to add there?
I'm going to do a hot take, which will
Yes.
be red meat for my two former regulatory colleagues, especially the one sitting right next to me. My hot take is, maybe the problem, maybe the challenge with stablecoins is a symptom of a larger problem, particularly in banking, in terms of just doing anything new at all, bank formations, new licenses. I mean, the number of new charters and the like. It's been really hard for some people to work through this microphone's problem that I this microphone problem I have. But it's really a challenge. I mean, we have incentive structures, we have almost an expectation that you are going to have minimal sort of new entrants into the banking and payment space,
Yep.
and then others have to make Herculean efforts to try to push back against it. But then, every 4 years, if something changes, and if you have a set of folks who view the risk reward as being one of absolutes, whereby you think the new entrant or enabling the new entrant only carries downside, without understanding that, inaction also carries risk and
Sure.
downside, then when you get to something truly new and innovative, and especially that's operating on a different kind of a rail, it can stymie and freeze policy development. And I think that's what we've seen the last couple of years. But I think sometimes it's useful to look at the larger, at first I did with Libra, but even here to understand the larger arc of certain kinds of problems that are embedded, in the regulatory process. So go for it.
I couldn't even hear what you said. I don't know if you guys can hear us, but we can barely hear each other on the
Basically,
stage.
it's hard to create a bank charter,
Okay, we're good,
therefore,
we're good, we're
therefore
good,
it's hard
we're
to do
good.
this.
I'm good with that. I think from my perspective, Alex, back to your question.
Yeah.
If you were building stablecoins over the last 4 years, you were either a little bit delusional and a big dreamer, or you actually were one of those machinating geniuses who understood that the bill will pass. Because back in 2021, there was a president's working group that encompassed several agencies, and the Fed and I think it was the Fed and the FDIC were not a party to the president's working group, but we signed on. And the idea between this work project, which was in October of 2021, was to basically create a path for a regulatory approach to stablecoins. And so we're talking almost 4 years ago, right? So what happened is that there was a report that came out, and initially in the discussions of that report, we were talking about stablecoin being issued by non-depository institutions and depository institutions. And frankly, the dichotomy between the two was, if we allow banks to issue stablecoins, and they are, to your point, Mark, 100% HQLA backed up, one-to-one reserves, then do we still want banks to hold capital against it, right? And there were those that said, yes, we do. Well, the second you ask the banks to hold capital against that too, in addition to the high quality 100% backed reserves, like, you killed it. No bank is going to, like, they're ponying up capital in two ways to basically procure for the same stablecoin. So that one was like dead. And then politically, they took out the non-insured depository institutions' ability to issue stablecoins. At that point in time, I believe it was Sherrod Brown, who was the chairman of the Senate Banking Committee, who basically said no legislation will move through Congress if the non-banks are able to issue this. So that's 4 years ago. So if the last 4 years you were building and you were aware of that, so fortunately for you, if you were building and you weren't aware of that, you actually built. If you were aware of that, you probably turned over to other digital assets, because why bother?
Sure.
But I do think that what's going to happen now with the legislation passing through, and do not underestimate how long regulations will take to come out of that legislation. That's actually, it's not like this, it actually takes about a year to go through the Administrative Procedures Act and other regulatory things that you have to do to pass regulations, which are actually the implementing of the law. And so what I think is going to happen, if you've been building all along, whatever you've built, you'll try to massage and make it look like what's the regulatory, desired version of that. And if you haven't been building, that actually in a way gives you an opportunity to build anew based on these specifications. So I do think this is going to be one of those aha moments in the stable coin, maybe not the digital assets, I think it's digital assets too, but the stable coin space, where if you've been building and you've been good, you can tweak that, make it fit within the regulatory framework, and then you're good to go, because the banks and other financial institutions now have a blessing from Congress and regulators soon to be able to hold and deal in those. And if you haven't been building, but you know how to build, there's that. I think this is an opportunity to start fresh without any baggage of what you thought regulators could approve.
Mark, anything you want to add?
Just a quick point. If I understood yours correctly, Professor Brummer.
Yes.
Don't call him professor.
Yes.
Did you say that it's an issue of not enough charters were actually granted, or there's an issue of the authority not being there?
Yeah, I was saying, and I can only even hear half of your question, but I think what you're asking, I'll answer what I think you're asking. I was trying to say that it's taken a lot of effort from regulators sitting next to me to actually facilitate and to help, and think about even in Travis Hill right now, to actually facilitate the creation of new bank charters is not and has not historically been an easy process, and so we can't be too surprised that facilitating new entrants in this particular stablecoins is going to be easy either.
So, just to wrap it up, I guess, in this question, the one point I would make, I totally agree with what Chris said, and I point out this book by Ezra Klein.
Yes.
Recently, and he doesn't touch at all upon financial services, I don't think. I haven't gotten all the way through the book yet, but Ezra Klein, as a lot of people probably know, is a pretty progressive thought leader, journalist, op-ed writer for the New York Times. squarely associated with the left and progressives from a political perspective. But he's written this book called Abundance, and he talks at length about how everything has become too complicated from a regulatory perspective. And I think what we saw with respect to the election results last fall was partly a reflection of that. And it's also, I think, again, part of Ezra Klein's book, this mentality that the goal should be to try to squeeze out and eliminate all risk at all costs.
Yes.
And try to anticipate every bad thing that could possibly happen and approach policymaking from that perspective. And it's not a popular view. I come from that side of the aisle, generally speaking. It's not a popular view, but that's a mistaken way to approach policy. You have to understand that there's going to be risks. You want there to be some risks. Figure out ways to have it properly managed. But otherwise, we're not going to move forward on a lot of different things, whether that's making the ease of payments simpler, whether that's building big public projects. We're getting really off topic now, but whatever the case might be. So I agree with you, and I think there's an understanding and acknowledgement across the political spectrum more and more that this is a problem.
Alex, can I just moderate for a second?
Moderate.
Thank you. I think we need to be honest, and I think most of the panelists here are like, this is a unique bunch of people who are actually just very direct. I think a lot of these questions are about, why didn't the regulators do it? Why didn't legislation pass? And, I think even in Klein's book, it's easy to say it's so difficult. Yeah. We've dealt as regulators with difficult things before, okay? Try to define a credit default swap. Okay, good luck with that. But it's difficult and we've dealt with it. So the issue is not really, is it difficult, do we know how to define it, etc. The issue was there political will to do this? And there hasn't been political will. And frankly, the reason that there hasn't been political will is because we as a country, and as politicians make things more complicated, and I worked in politics for some time, but the truth of the matter is that the country was at not the country, the politicians were divided into those who liked the disruptors and who tried to preserve the status quo.
Yep.
Yeah. And the people who tried to preserve the status quo, they didn't want novel banking charters, they didn't want banking as a service, they didn't want fintechs in this space, they didn't want stablecoins, crypto, whatever kind of a crypto assets, they wanted postal banking system, they wanted all of the government, all of the small dollar lending to be done by the government because they can control the flow of money, they wanted the financial rails controlled by the government. So that's one group of people. The other group of people was like, let's make this new manifest destiny. Let's go as far as we can. Move fast, and we want to decentralize the system. And so in between were people who were like, well, maybe we keep some of the old, maybe we take some of the new, and those people got drowned. And so really, the folks who wanted to preserve the de facto system didn't have political will. This is not about it being hard.
Yeah. You teed up the next section of what I wanted to talk about perfectly. Wonderful job moderating, by the way. That was great. That was great. I just want to sit and watch. So the thing we're sort of circling around that I want to dig into a little bit and get into the actual legislation is this distinction between ensuring we have a safe and sound financial system and encouraging disruption and innovation versus protecting incumbents. And I think those two things get mixed up a lot, right? And so the thing I've observed watching all the debate around the Genius Act, around the Stable Act, around sort of legislation, what do we want regulation in this space to look like, is policymakers trying to parse the difference between those two things, right? And obviously I think there is right now political will for empowering disruption, empowering innovation, but, we have former regulators on stage, prudential regulators are in their heart of hearts safety and soundness people also, right? And that is the core job. So I want to talk first really quickly about what actually is in the legislation. Flavia, we voted backstage when you were not there, and we deemed that you were the one who had to answer this question. Can you give us a very quick summary, nice job, of what is in the Genius Act and where we are right now? Because obviously, it changes on a minute-by-minute basis, but give us the latest.
Yeah, with a full disclaimer that it changes minute by minute.
It does.
And what I know from 2 days ago may not be what it is this morning. So this is, to Yelena's point, something that has been in the works for 4 years. And it's finally happening because there is a political drive to actually make this happen. Because you have people that actually understand a balance of risk and that you're not going to bubble wrap anything, and you need to accept some sort of risk and put controls in place, and that's how you move on as a business. So it is a bill to regulate fiat-backed stablecoins. It is not to regulate issuance of yield on these tokens. It actually says that a permitted issuer, or forget the name of the definition, is not someone that issues yield. So if the fiat-backed stable token in its native issuance is generating yield to the holder, it does not fit the bill, number one. The other thing that is really important is that it clarifies that this is not a security. Again, if it doesn't generate yield, right? So it's not a security, and then you can progress into being a payment. This is actually a payment token. The other element that is important is talk about the reserves, and it goes into the safety and soundness.
Yep.
Again, what I said earlier, if you do not have trust in the reserves, you do not have a stablecoin, right? So it talks about the reserves. What I want to see happening is, to Yelena's point, is the implementation and how this is actually going to come into fruition, and how it is that the reserves are actually going to be managed on a day-to-day basis. Because to talk about it is one thing, and to actually do it, it's something else. So what we're going to have the gap is having the banking regulators actually come up with a charter for these issuers, right, the ones that are not banks, and how they're going to be regulated for this type of activity. And the last point that is actually really interesting is that it tries to solve the confusion that exists today between the state and federal level. So you're still going to have state regulators issuing licenses for stablecoin issuers up to a certain level, right? However, they will have more harmonization at the state level. Because today at the state level, you can be a trust company, you can be a money transmitter, or you can be a state bank, or you can be nothing else and just issue a stablecoin, right? It is very difficult to manage if you are an issuer at the state level today. And what the Genius Act is trying to say, okay, if you are a state chartered bank and you're going to issue a token, you do not need to get money transmission licenses in other states. So that kind of brings that tone, that harmonizes that at the state level as well, which is really, really important. So having been through this for 5 years now, besides all these exciting jobs that I have today, I also spent time at an issuer in the past. And just seeing what we are today and the evolution, it's so important and so refreshing, and actually very exciting to see the next step. I do agree that having the political drive is the main one thing. This hasn't happened before because it's risky, because it's scary, because it's boogeyman. Because you know what? PayPal was boogeyman when it was created, right? And I'm old enough to remember when PayPal came out, and it was boogeyman back then, right? Oh, you're putting money on the internet. You're going to be doing bad things with it, right? No. I mean, I don't carry cash with me anymore. I don't know about you guys, right? But I function with my phone. We need to be able to have that kind of ability. This is very exciting. So I'm actually looking for, and the Genius Act, as I understand, of 2 days ago, is going up for vote at the House, and they are supposed to be accepting it as is, and then recommending it that be voted instead of trying to harmonize the Stable Act with the Genius Act. The House will vote on the Genius Act in itself, and that will be the one that moves forward. So fingers crossed that this happens in the next couple of weeks, unless some other token gets issued by some politician, and then we don't do things anymore, right?
All right, well, that was a wonderful summary, so good job to Flavia. That was very good. Round of applause for Flavia.
A+.
Very good.
It's what happens when you're not backstage.
That's right. She slipped out to get coffee, and we totally stacked the deck against her. So, as you illustrated, a bunch of stuff has changed over time as they've negotiated. There have been multiple objections raised from industry stakeholders, from policymakers, from legislators. And again, I think it's a mistake to just lump everything in one group or another, right? We could look at all of the objections to regulated stablecoin framework as good faith objections about, policy making and how do we ensure a safe and sound system, or we could lump all of them into the category of, this is just nonsense from incumbents who don't want to see the industry change. I want to take a slightly more nuanced view, and in particular, given the crowd that we have, I think it would be good to pick out some of the objections or concerns that you all feel are good faith concerns or objections. Maybe these are things that have been addressed in the changes that have been made to the bill. Maybe these are things that can be addressed when it gets translated into rules and regulations. But for each of you, like, what's one area where you think, yeah, you know, that's a good point. That's something we need to kind of solve for. That's something that we have solved for throughout the process of legislating this. Chris, I'm going to go with you first.
I cannot look into the hearts of men.
Yes, you can. Yes, you can. I know you can.
To determine, what is, what degree of good faith people have. I think part of it is because, my view of human nature as I become older and older is that people are sometimes neither good nor bad, but they are frequently lazy, right? and so objections may arise, just like support, because people aren't always willing to do their homework.
Yep.
And so it's very convenient sometimes to just sort of say something. And so it can still be good faith in the sense of it being sincerely felt, but it may not necessarily be the product of doing the hard work of figuring out how the stuff works. Now, I think as a general matter, I think it is worth certainly understanding that whenever you have a stablecoin, there are certain kinds of risks that inhere. You always have counterparty risk, and so you want to figure out what is that counterparty risk and what are the measures that are being deployed to help to speak to that counterparty risk. There are certainly monetary questions that arise, in terms of who would be the backstop, monetary transmission and the like. I think one of the issues that we haven't brought up, where I think there was a good faith question, and where we've had solutions before in the past, and where there's been movement between one version of the bill and the other, would be the foreign issuer question, right?
Yeah.
And part of that is tied to the to KYI and the like. I think it's certainly the case that if you have an international actor who is dominant and very large in the space and doing things, you have to ask yourself, well, what does regulation mean, both when it comes to what's required to take that actor and to bring it into the perimeter here in the United States, what are the trade-offs? And then what are the trade-offs if you don't bring it into the regulatory perimeter and you allow those foreign actors to act and to facilitate and to do things outside of the United States? What does it mean for U.S. competitiveness? What does it mean for the competitiveness of our actors, but also what does it mean for the risk profile for U.S. consumers? And I think that what you've seen is this idea, and it's an old idea, frankly, one that I remember when I first came to Washington. There was this idea of in the post-Dodd-Frank era of like equivalence, and what does equivalence mean?
Sure.
And now I'm seeing repeated themes, here, which is to sort of say, hey, look, if you want to operate in the United States, you better comply with our regulatory regime, or you must be operating in a regime that's deemed to be sort of equivalent to the one in which we're operating in. And I think that that's certainly, it comes from a perfectly legitimate critique.
Yep.
Equivalence is always, again, there's a very long history of equivalence and different ways of getting to it and figuring it out, and it's usually kind of, you kind of stumble through it, usually from a regulatory perspective, whether or not at the CFTC or the SEC, whether or not you try to figure it out for, Basel capital purposes. And I think you would see that inevitably and invariably play out here. So I guess that hopefully is an example for you.
Yeah, that's a good one. And I'm glad you mentioned the company that shall not be named as well. Elena, do you want to go next?
Yeah, so I think that it's important to, again, distinguish here between politics and the substance of it, right?
Sure.
So politically, people will raise objections to this and that, and truly, honestly, a lot of times, they are just trading chips. It's like, I'll give you my horse for your donkey, and you try to get something else in legislation for this, and this is how you get language about, salmon fishing in California in the National Defense Authorization Act, right?
Sure.
So I think people should be leery of what objections get raised, because I think most of them are just trading tools in the negotiation process. I think on the substantive side, I think it's going to be interesting how the regulators define. See, the legislators have an easy job. They say stablecoin,
Yeah.
and you're like,
Okay.
okay, supposed to be a coin, whatever that means, and stable, whatever that means. And then it's going to be on the regulators to define exactly what that means, and just foreseeing what all could be that they don't want in the definition of the stable coin, which is how, you know, with proprietary trading and the VOCA rule, for example, it was so hard to define things that the regulators issued 21 sets of frequently asked questions to redefine what was in the rule without reopening the rule. So I think where we're going to see some of, like, it's a legitimate actually concern. How do you define it? Define it on a regulatory side, which is why I think the legislators have an easier task. They just say, you know, same thing for example, you know, when I was at the FDIC, we dealt with brokered deposits. I don't know how many of you deal with brokered deposits. There is no definition of brokered deposit in legislation, in the law.
It's just
the
whatever
law
comes
says,
from a broker,
The law says broker of deposits.
Yeah.
And we know what deposits are, but what the heck is a broker?
Right.
In this context. So it's like, truly, do not think that just because the legislation passed, the battle is done. There are these regulators, God bless them for most part, who actually have to write out technically what that means. And that's the devil is in the detail in that process.
Can I just jump in there, because that's very clever, although like dark. I mean, I thought I was just by saying lazy, and you're just getting into, you know, I have this little casino somewhere in the back of Congress, and people are just like, I'll trade your red for my, you know, blue chips or something. But and that's true. You know, it is you know, one of the most interesting examples of things that are not generally defined, particularly when you get to my example of the international level. It's like the word bank, right? Which is super interesting. When you get to like the Basel Capital Accord or something, and you're sort of searching around and like, okay, you know, you see the word bank everywhere, and you're trying to figure out but we all, of course, understand what a bank is, right? And it is usually, you know, the hard work of the regulator to sort of provide flesh and some meat on the bones for some of the key concepts.
And sorry, Mark, but I have to actually offer something else here. So, and I'm sorry, Flavia, I will not put you on the spot. You don't have to say anything about this. But the whole issue about the Wyoming charter for banks that could be crypto banks is the issue of whether or not you have access to the master account at the Fed. And the way that the law is written, it said it has to be an insured depository institution. It does not say it has to be federally insured depository institution, because when the law was drafted, the only thing out there was the FDIC insurance. States didn't offer insurance. So I offered that only and so the people who are on the side of the Wyoming, you know, do not comment, charter, I'm doing your bidding here. They basically will say that the law says insured depository institution, we are insured, we should have access to the master account, because the law doesn't say we can't. And the people who are against it, which won't be named, but maybe their acronym starts with an F and has only 3 letters, you know, they will basically say, but the law didn't anticipate state insurance, because then anybody could have a master account. So like, do not, I use that as an example because it's relevant to crypto, but I also use it as an example of something that do not underestimate how much more work there is to do.
So, and I'm going to cut in front of Mark. I'm so sorry, but these two brought up a very good point, is the definition of bank that has been an issue forever, especially in the dual banking structure that we have today. States may define bank in one way, the federal government, and all states have their own definition. So you have 50 definitions, and then you have the federal definition, and then you have a narrow bank. And then you have a special purpose depository institution. And then you have an industrial bank. And then you have a this, and then you have a that. So to the point of complexity, into how is it that this is, again, not harmonized and confusing, we create that confusion on us. So we just keep on bringing that up. And for the sake of technology advancing on the fringes, not addressing the main issue because it's hard. It's very hard to stop and think about that. So you keep on going around and then creating all these other things, and then just raising more and more issues because they're trying to get around. So the net that you have to actually cover, it's much wider right now, and you have all these discrepancies that need to be harmonized. And how do you do that, maintaining the autonomy that the states have to charter banks on their own, but at the same time creating a fair playing field for issuers so that they understand what they need to do. Because today, you don't understand what you need to do. And sometimes, what is a bank? Very good point. But Mark, please.
Sorry, Mark.
Jump on in there, Mark.
Yeah,
Well,
so Mark.
He can repeat the question because we have now had like an ADHD convention on the stage about how difficult it is to implement stuff.
Yeah, one issue I think is interesting is that we're now in this post-Loper-Bright era.
I'm glad you brought that up, yeah.
So it'll be interesting to see what will happen post-implementation by the regulatory agencies, and you wonder how much litigation there will be after rules are promulgated. You wonder how the courts are going to decide those cases. And for a little bit of the benefit of the audience, that case basically, I'm paraphrasing and oversimplifying here, but that Supreme Court case basically said that courts don't have to defer so much to the federal regulators about what the meaning of legislation is. And so I think a lot of people predicted that we would start to see legislation that got more granular. And in the context of the Genius Act, in the context of the House introduced market structure bill, I'm not seeing that. What I'm seeing in these bills is a considerable amount of work to be done by the regulators, giving them a fair amount of discretion. And so for those reasons, I think it sets up kind of an interesting dynamic, and it's going to make it a little hard to predict how all of these things get implemented, number one, and then how they get litigated and how they get resolved.
Yeah, no, I'm glad you brought that up, because the world we're headed into next, I mean, this is where the hard work actually begins in a lot of ways, right? I mean, we've been fighting and fighting to get legislation passed and to have some kind of clear framework, but the actual process of building out the rules, harmonizing these things, figuring out the definitions, figuring out what you can do that maybe won't be challenged later, like there's a whole set of complexity that's coming. So I want to end with this, because beyond the regulatory environment, there are certain issues, I think, around stablecoins that can't necessarily be addressed by regulation. And in fact, Elaine, I think you were the one who mentioned it at the beginning, a lot of the progress we've made so far was driven by the market, not by regulation. So for folks in the audience who are building in this space, I'm wondering if each of you can just give one suggestion or piece of advice or thing that you'd like to see the market focus on, even in a post-regulated world. Flavia, why don't we start with you and we'll work our way down.
Yeah, it's interesting because at every point in time which I speak to a regulator about this, the first point is the industry needs to drive it. Well, yeah, the industry will drive it, but if there's political impediment, how do you actually drive? So I would say for the industry to continue working to push this ahead, I think the critical thing, not to be, beating a dead horse or broken record here, is build on something that there's trust in the reserves. Safety and soundness of this is what is going to legitimize this industry, right? Coming with projects that may overlook that safety and soundness, may overlook principles of the Bank Secrecy Act, may overlook, ensuring that the reserves are safe and that the holder of that token knows what the reserves are, is the most critical thing, right? It's a huge job to be a stablecoin issuer because you're actually holding people's money. That money doesn't belong to you. You're a custodian for them. That's a huge responsibility. And some people don't take that seriously. And if you don't take that seriously, you cannot operate in this industry. I am like the compliance officer by heart. BSA compliance officer, this is like so important. So have that principle when we're building on stablecoins, that this is to facilitate the custody of people's money, and it's a huge job. So building with that kind of principle and that trust is what is going to make a successful product.
Yeah, I'll just echo that and say, I don't know if there's any such thing as a successful sort of environment for finance that is truly trustless. People want to be able to trust something. And if you're not building your systems, I'd add, like what we're doing at Blueprint is 100% transparency. We work with central banks. We also own the reserves issue. And, if you're not building things that people trust, you're not going to be you're not going to be able to build successful projects and infrastructure. So, whether or not it's regulatorily required, the market's going to require it of you, and you should build to last.
Just to outdo Chris, I'll offer 2 pieces of advice. So the first one is, do not underestimate how much you still have to get engaged with the regulators on this. There is something that's called the Administrative Procedures Act, and pursuant to that, the regulators have to issue regulations for comment, basically a proposal, and it is really important in that process that you provide your input, especially if you're building something that doesn't look like what the others are building, because as a former regulatory attorney, I had to read thousands of the comment letters, and when something was legitimately like a good argument against what we were working on, like you actually take it and you start thinking about technically how does this work. So do not underestimate the ability to and the necessity to engage with the regulators in the rulemaking process. And the second piece of advice is the more difficult one, frankly, which is that do not underestimate how much a single bad actor can drag any progress back. Okay, it's easy to we'll use history. It's easy to beat up on people who did wrong, but for example, what FTX did and how that came down set the industry back by good 3 years, frankly, and it allowed the regulators, especially the folks who were in that camp where I said they don't want to disrupt they want to keep the status quo because they can control the monetary rails and the flow of money and the distribution of money. It gave an excuse, it gave a cover to those people to basically say, here is why crypto's bad, and here's why, if you're a bank, you shouldn't regulate crypto. And so I kind of think of like the ants and the bees as the most effective of all societies, and ants have this thing where there's like a rogue ant. They kind of push that rogue ant out. I mean, they kill them really, but you don't have to do that, it's illegal. But it is important that you self-govern the industry and that you basically, if you know there are bad players, either, if they're unknowingly bad players, then tell them that, but if they are truly bad players, it's important for the industry to kind of take care of its own.
Yep. Mark?
I was just going to say, this is a great moment for the industry, so now's the time. If people have a product idea, if they have any idea related to stablecoins or more broadly the crypto asset space, this is probably as good an environment as you're going to get from a regulatory perspective. So the idea is there, now's the time. And
Awesome.
I would agree with what Jelena said too. It's unfortunately a couple of bad events can give folks who are in the political space reasons to stop innovation and to focus on risks rather than some of the benefits of constructively approaching these challenges.
That's a great point. All right, that's all the time we have. Please join me in thanking our panelists. Great.